What's up, guys? In this video, I'm going to break down the strategy I would use to analyze and execute two high probability trading scenarios. Let's begin with the first one. Now, the price action in this 15-minute time frame of Euro USD is relatively simple to understand, obviously due to the noticeable sideways movement that I have highlighted taking place at this level. Consequently, this leads to the formation of a stop hunt area, which in my opinion marks the top of this entire trading range. Another way to figure out the peak here could be the use of the Wyckoff method of technical analysis. Obviously, if you have been keeping up with my content, you will know that this price action based strategy forms the core of my entries or trading decisions. Essentially, we are looking at a three-phase process here, which includes the accumulation phase, the markup phase, and the distribution phase. Understanding this cycle helps you as a trader see the connection between price changes, market phases, and smart money flows. So it makes sense for me, after finding the simplest and most likely explanation for a series of observations that I just explained, to conclude that this upper area is simply a stop hunt area. Now, this interpretation is further backed by a break-in market structure down here, which you'll notice occurs below the FIBS 50% retracement level. Obviously, this detail gives us a clue about the market's lean towards bearish tendencies. It's also worth noting, as I've often emphasized in my videos, that it's best to engage in trades during their expansion phases. I think that this particular action fits that bill. The next step is simply to wait for liquidity to build up on this side of the market. Once there is sufficient liquidity on both sides, we can expect, based on Wyckoff's principles of price movement, that the price is gearing up to enter the next expansion phase. So once we reach a state of price equilibrium, we watch for an entry signal, and obviously that signal comes when we break the previous candle low here, at which point we go short. The first target should be set at this double bottom level, while the subsequent target should be positioned within this support zone. Stop loss goes up here. The idea here, guys, is to use Wyckoff's method of technical analysis to increase your ability to get better at deciding when to make a trade. It's all about, I think, predicting and planning for future market movements and making sure the potential benefits outweigh the risks before you go ahead with the trade. Let's now move on and look into another approach of how to spot a high probability trade. In this section of the 1-minute time frame, we can see NVIDIA's downward tendencies continue to persist, becoming obvious when the stock fails to test this high. Initially, the ticker shows a weak breakthrough above the resistance level of this consolidation channel. This is subsequently followed by a sequence of lower highs before the stock takes a solid dive. At the same time, this whole downward movement, especially after the first reversal down here, acts as a visual cue that a trend shift might be approaching, indicating a possible exhaustion point for the equity. This idea is further supported, in my view, by the printing of a higher low in this area, which, particularly following this break-in market structure, suggests a shift towards the demand side. In other words, the technical elements I just mentioned mark the start of a downtrend halt. And as you can see from the chart, once the break of structure level is cleared, a key level to be reclaimed by the bulls in order to continue the price recovery, the stock rolls higher, rebalancing all this. The market then trades down, re-entering the FIBS oversold retracement levels. Obviously, this decline, supported by an ascending trend line finds a provisional base with a lower limit of this imbalance zone, which serves as a signal to initiate a long scalping position in the stock. Remember guys, a new cycle of trading activity begins with a period of accumulation or distribution during which prices form a range. This stage, where different and not so obvious technical factors or drivers can have a significant impact on price changes. So this stage could be marked by low volatility and relatively low trading volumes as the market is being quiet before the next move. And when the market is going through such price change phases, it means that it is undergoing a shift towards a new trend. By exploring and uncovering these influences, you can gain a better or deeper understanding of the market and make more informed trading decisions. And this next video here is going to show you how to do just that and perhaps help you elevate your trading game.